We broke a 9-month streak of having worse than expected numbers, and now we get one number that's not as bad as expected, and somehow we're out of the woods. I think that's ridiculous. You know, if you annualize even that 0.3, that annualizes to 4% inflation a year, which in and of itself is pretty bad. But if you look at the actual increase in consumer prices in the first 8 months of this calendar year and then annualize that, that's 6.4%. So we're still triple the 2% that the Fed is claiming it's the target. You know, it says it wants to be slightly above 2%, right? Well, we're not even in the neighborhood of 2%. And the number would be much, much higher if the government was not using owner's equivalent rent, which is, you know, like a third of the index. And this number is supposed to represent housing costs, but it doesn't even come close, because if you look at what's actually happening to rents or home prices, we've never seen these kind of increases. These are double-digit increases in the cost of buying or renting a home, yet none of that is reflected in the CPI. In fact, the government claims that shelter prices are rising so slowly that it's actually weighing down the CPI. The number would be much higher, obviously, if we use the real rate of increase of rent or home prices, not what the government is pretending the increase is.
Okay, so one of the things I want to talk to you about is there's obviously, when you have data, people can manipulate that data, massage the data to say all kinds of things. So I could take the data that came out today and I could make an argument that inflation is going down and it's a really positive story. I could take the data and paint a picture that it's really bad and everything, the world's going to end, whatever. Explain around housing specifically. What is the data that you're looking at where you're saying to yourself, okay, this data is showing very high and rapid price appreciation? And then explain what the CPI number accounts for, what the difference between those two things are.
Well, the housing component, I think, owner's equivalent rent in August, which is the month we got today, they have as 0.2 is the increase. And I think year over year, I'm not even sure if it's at 3%. But if you look at housing prices year over year, they're up almost 20%, like 19% or something like that. This is one of the biggest years ever for home prices. And if you look at rents, I think rents year over year are up about 13%. And that's based on companies that actually track rents, right? Websites that, you know, are tracking what homes are renting for. So the real data is at odds with the government data. The real data is much, much higher. And of course, everything associated with home ownership. Your utility bills are going way up. Your insurance costs are going way up. Your taxes are going up. So every aspect of renting or buying a home is going up in addition to what it costs you to buy it or rent it. And it's not, of course, not just shelter components that are going up. Everything is getting more expensive. And if people think that's transitory, it's because they don't understand the problem. In fact, they don't even understand inflation or where it comes from, because inflation is about money. You're inflating the money supply. That's what's being expanded. And none of this is transitory because these deficits aren't transitory. The money printing isn't transitory. It's here to stay. We're at QE infinity. The Fed's balance sheet is going to continue to expand, and that means prices are going to keep going up because we continue to destroy the value of the dollar as we expand the supply.
When you think about the term transitory, we talked about it a little bit earlier, where it's just the definition is not permanent. So there's no kind of quantifiable, hey, it's above this percent for, you know, this number of years or anything like that. What do you think is the metric that would have to be hit in order to qualify as transitory? Is it something where if CPI all of a sudden went sub 2% next month, then you'd be like, yeah, it was transitory? Or have we already breached kind of the idea of transitory inflation and we're well now into a kind of a permanent, kind of status?
Well, the Federal Reserve already changed the definition of transitory, because in the beginning, the way it defined transitory, at least, you know, when you heard their explanation, it meant a temporary increase in prices that would go away. So in other words, prices came up because of the reopening of the economy and because of some supply bottlenecks. But once the economy reopened and those bottlenecks, cleared up, the prices that went up would come right back down to where they were. So that's what most people believed transitory was, that prices will be high for a while, but then they're going to come back down to where they would have been. The Fed has already backtracked on that initial definition. According to the Fed now, the price increases that they're saying are transitory are in fact permanent, that we're never going to have a reduction in prices. They're going to stay at this higher level. What the Fed now means by transitory is once prices stop going up by 8% or 10% a year, they will go back to only going up by 2% a year. But those 2% per year increases will be on top of all these increases that we already experienced. So in other words, if we get a transitory, let's say 20% increase in prices, that 20% price increases, we're going to be living with that forever. In fact, then we're going to get 2% per year in addition to that. So to me, that really represents a massive inflation tax, because you're going to need 20% more money to buy the same amount of stuff that you were able to buy before the transitory period took place.
When you start to think about the idea of the supply chain bottlenecks, there definitely are some supply chain disruptions that have occurred. I think everyone agrees that, to some degree that is true. How do you start to separate out what is price increases due to supply chain versus what is due to monetary or fiscal policy, and then what is due to rising labor costs? Is there a way that, or like a framework you use to evaluate when the price of a good or a service goes up? How do you attribute the driver of that price increase?
Well, certainly, whenever you have a big increase in the money supply, you can always claim that there's a supply shortage, because there's not going to be enough supply to meet all that demand. Because normally, the way demand comes into existence is through the creation of supply, right? So let's say people do work, they perform goods and services, and as a reward for performing services or helping to produce goods, they earn money. And so now that demand, their paycheck, they can now use that money to buy the stuff that they helped produce. So there's supply to go with the demand. But if people are just sitting at home and they're not producing anything, and the government just prints money and gives it to them, and now they want to go and buy it, there's obviously a shortage of supply, because they did not help supply anything. All they're doing is demanding to buy stuff that they didn't help produce with the money that the Fed printed. So the only way to clear the market, to have supply and demand balance, is for prices to go up. And then prices will go up to the point where now supply and demand meet. So, this is always going to happen. And it's very easy to blame a surplus of money on a shortage of goods, right? Because you could always do that. I mean, think about it. What if the U.S. government gave everybody $1 million, right? Everybody in America got $1 million. And now one of the first things everybody wanted to do was buy a new Lamborghini, right? That's what you crypto guys want. You want your new Lambos. So